In today's dynamic tech-driven market, selecting the right stocks requires a meticulous process backed by data and reasoning. We begin by filtering through the vast array of NASDAQ-listed companies, focusing on those with robust competitive advantages. Our primary criterion is a gross profit margin exceeding 60%, indicative of companies with significant moats. After applying this filter, we've narrowed down our initial list to 45 promising candidates. Let's delve into the analysis of 3 notable tech stocks: Autodesk, Synopsys, and Airbnb. Autodesk, renowned for its flagship software AutoCAD, stands out as a leading player in the software industry. Its financial highlights paint a picture of strength and resilience. With a staggering gross profit margin of 91%, Autodesk demonstrates its ability to generate substantial profits from its operations. Furthermore, the company boasts a healthy net income margin of approximately 20% and an impressive return on invested capital of 22%. A notable profit growth rate of 14% coupled with a robust cash flow of $2 billion in the last 12 months underscores the company's financial prowess. Despite a relatively high price-to-earnings (P/E) ratio of 31x, there's ample justification for this valuation. The potential for future growth, driven by Autodesk's dominance in its niche and consistent performance, suggests that current investors may reap substantial rewards over the long term. Moving on to Synopsys, a semiconductor company integral to chip development, we encounter another compelling investment opportunity. While specific gross profit margin figures aren't provided, the company is described as having a high margin, indicative of its profitability. Synopsys boasts an impressive return on capital employed of 177% and a commendable profit growth rate of 18%. Despite a P/E ratio of 42x, investors should view this valuation in the context of Synopsys's critical role in semiconductor development. With increasing demand for chips, particularly in AI-related applications, Synopsys is well-positioned to capitalize on emerging trends. The company's positive outlook, coupled with its indispensable services, justifies the current valuation. Lastly, we turn our attention to Airbnb, a disruptor in the hospitality industry with its platform for short-term property rentals. Airbnb's financials reflect its status as a formidable player in the market. With a gross profit margin of 82% and a healthy return on invested capital of 14%, the company demonstrates solid financial performance. Strong cash flow of $3.8 billion in the last 12 months further bolsters Airbnb's investment appeal. Despite a P/E ratio of 37x, long-term investors stand to benefit from the company's unique value proposition, profitability, and growth potential. As Airbnb continues to innovate and expand its offerings, it remains a compelling investment choice in the tech sector. In the broader market context, it's essential to acknowledge the significance of high-margin businesses like Amazon Web Services, AWS. AWS contribution underscores the overall market dynamics, highlighting the importance of diversified revenue streams and profitability. Additionally, sectors such as advertising and cloud services continue to exhibit strength, reflecting ongoing shifts in consumer behavior and technological advancements. In conclusion, the tech sector offers a plethora of investment opportunities for discerning investors. By employing a rigorous selection process and analyzing key financial metrics, investors can identify companies with strong competitive advantages and growth potential. Stocks like Autodesk, Synopsys, and Airbnb exemplify these qualities, presenting compelling investment cases despite varying valuation metrics. Please go ahead by liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.